In FY 2023, the banking sector experienced its most profitable year, with both PSU and private banks surpassing 1 lakh crore in profit each. PSU banks achieved profits of 1.08 lakh crore, while the private sector recorded profits of 1.23 lakh crores. This exceptional performance can be attributed to factors such as high yield, robust loan growth, rising interest rates, and reduced credit cost in FY23. Notably, SBI alone generated profits of 50,000 crore, with the remaining top 9 PSBs contributing 40,000 crore in profits during FY23. The public sector banking has witnessed a remarkable turnaround, transitioning from record losses to record profits. When comparing the profit and loss of the top 10 PSBs from 2013 to 2023, there was a decline in profits from 2013 to 2019, culminating in significant losses during FY 2018-2019. However, the situation took a positive turn from 2020 onwards, leading to record profits in FY 2023. This doom to bloom transformation of the PSBs can be attributed to the initiatives and reforms undertaken by the government. The government implemented a comprehensive 4R strategy, which encompassed key elements such as transparent recognition of non-performing assets, resolution and recovery processes, recapitalization of PSBs, and reforms in the financial ecosystem. As part of this strategy, the government infused an unprecedented amount of 3.1 lakh crore to recapitalize PSBs between 2018 and 2023. These reforms, spanning over the course of 8 years, focused on instilling credit discipline, promoting responsible lending practices, and enhancing governance within the banking sector. Additionally, there were notable measures such as the adoption of technology, consolidation through bank amalgamation, and the maintenance of overall confidence among bankers. Furthermore, the government extended the tenure of managing directors and CEOs from 5 to 10 years. This move aims to retain talent and foster younger leadership, capable of driving the long-term vision of PSBs. Thanks to the government reforms, there has been a significant improvement in the asset quality of PSBs. Gross non-performing assets of PSBs have witnessed a remarkable decline, transitioning from high double-digit values in 2019 to single-digit figures in 2020. This reduction in NPAs has led to a decrease in the provision requirements and subsequently boosted profits for PSBs. Furthermore, the overall stress in the banking system has shown a noticeable decrease. From its peak in 2018, with the gross NPAs at 11.18%, the banking system's stress level have reached a 7-year low of 5.38% in 2023. The resilience of PSBs has witnessed an improvement. The provision coverage ratio, which indicates the extent to which provisions cover potential losses, has seen a significant rise. It has increased from 46% in March of 2015 to an impressive 89.9% in December of 2022. This increase in provision coverage ratio highlights the strengthened ability of PSBs to handle potential loan losses. Another significant improvement is observed in the capital adequacy ratio of PSBs. The ratio, which measures a bank's capital strength in relation to its risk-weighted assets, has seen a notable rise. It has improved from 11.5% in March of 2015 to 14.5% in December of 2022, indicating enhanced capital adequacy and financial stability for PSBs. Moreover, there has been substantial growth in the total market capitalization of PSBs. It has increased from 4.52 lakh crore in March of 2018 to 10.63 lakh crore in December of 2022. This growth signifies increased market confidence and investor interest in PSBs. To maintain a balanced asset mix, PSBs have gradually reduced their corporate loan book over the years. As of 2023, retail, SME, and agricultural loans account for 57% of the loan book. Specifically, the State Bank of India has a retail loan book of 42% compared to 35% in corporate loans, demonstrating a strategic shift in the composition of loans. Looking ahead to FY24, the operational performance of PSBs is anticipated to maintain its healthy trajectory. It is expected that the gross non-performing assets will decline further, reaching a projected level of 4%. However, it is worth noting that the net interest margin may experience a decline of 50 to 100 basis points due to an increase in the cost of funds. Despite this, the return ratios of PSBs are expected to remain robust, primarily driven by the decreasing provisions for bad loans. To stimulate loan growth, banks will actively seek to raise capital, ensuring they have the necessary resources to meet the demand for credit. With the ongoing decline in gross non-performing assets, there is a possibility that they may reach historically low levels, paving the way for continuous growth in the loan books of PSBs. However, it is crucial for banks to exercise caution and ensure the maintenance of asset quality while pursuing this growth. It is worth noting that banks typically take more than 3 to 4 years to detect bank frauds exceeding 100 crores. Therefore, the implementation of effective early warning systems becomes imperative for banks to mitigate potential risks. It is important to remain vigilant as the risk of NPAs increasing in the long term remains significant, especially during shift in the credit cycle. Additionally, the recent submission of a paper by the RBI on expected credit loss provisioning for banks has the potential to disrupt the profitability of PSBs, highlighting the need for careful risk management and financial planning. Looking ahead, there is a positive outlook for the next 1 to 2 years, driven by reduction in NPAs, credit growth, and government reforms. However, it is essential to exercise caution and adopt a prudent approach from a long-term perspective. The long-term sustained growth will depend on PSB's ability to manage asset quality and early detection of frauds, which will help them maintain the low NPAs.